Schwab, Fidelity, and Vanguard, the big three, dominate the US brokerage landscape, managing over $35 trillion in combined assets. That number is so large, it has become almost abstract. But here's what the number does not tell you. $35 trillion in assets is being protected by an insurance system whose coverage limit was last updated in 1980, the year the Sony Walkman launched. And the three specific blind spots most investors have about that protection are going to be the entire subject of today's video, because two of them are survivable and one of them is not. So yes, let's talk about what happens to your money if Schwab, Fidelity, or Vanguard goes under. And I mean really goes under. Not a bad quarter, not a stock price drop, bankruptcy. Liquidation. The kind of scenario where a CEO is getting deposed in front of a Senate committee. Here's the first thing you need to understand, because it dismantles most of the panic immediately. A brokerage firm is not a bank. The way they hold your money is fundamentally legally different. And if you don't understand that distinction, the rest of the conversation makes no sense. When you put money in a bank, a savings account, a CD, a money market, the bank takes ownership of your funds. You are not depositing cash into storage. You are lending money to an institution that then uses it to make loans, buy assets, fund its own operations. What you get in return is a promise to pay you back on demand. The bank is the borrower. You are the creditor. And if the bank fails, you become an unsecured creditor in a bankruptcy proceeding, competing with everyone else for what's left. That is why FDIC insurance exists. Without it, a bank run in 2023 looks very different. A brokerage works on a completely different legal framework. When you buy shares of Apple or an S&P 500 index fund through Schwab, those shares do not belong to Schwab. The securities in your brokerage account, including stocks, bonds, and ETFs, are segregated in compliance with the SEC's Customer Protection Rule, a legal requirement for all US broker-dealers. Your segregated assets are not available to general creditors and are protected against creditors' claims in the event a broker-dealer becomes insolvent. The brokerage is a custodian, a caretaker, not an owner. Here is the metaphor I want you to hold on to for this entire video, because it's going to come back. Think about a self-storage facility. You rent a unit, you put your furniture inside, you lock the door. If the storage company files for Chapter 11, the sheriff cannot show up and sell your couch to pay the company's electric bill. Your stuff is your stuff. The company holds the key, but not the ownership. The moment the company fails, the first thing a trustee does is figure out whose couch is whose and arrange to return it. That's what happens to your stocks and ETFs in a brokerage collapse. The storage facility is in trouble. Your furniture is fine. Stay with me. Because the storage facility analogy has one very important caveat, and it's the caveat that actually burned people in real history. In a few minutes, I'm going to show you the one specific scenario where the storage facility really can lose your couch. But first, let me explain exactly what the first layer of protection looks like in practice, because most people think they know, and most people have it slightly wrong. The Securities Investor Protection Corporation, SIPC, is a federally mandated, nonprofit, member-funded U.S. government corporation created under the Securities Investor Protection Act of 1970. Although created by federal legislation and overseen by the SEC, the SIPC is neither a government agency nor a regulator of broker-dealers. That distinction matters. The FDIC is a government agency with the full faith and credit of the United States behind it. SIPC is a private nonprofit. SIPC protects investment securities, but is a private nonprofit corporation. It does not carry a government backstop. Different animal entirely. In the failure of a SIPC member brokerage firm, SIPC may protect up to $500,000 per customer cash and securities, combined with a $250,000 limit on cash. But here's the part that changes everything for anyone with multiple account types. SIPC covers accounts at member brokerage firms that each have a separate capacity, a different investing purpose or ownership. Individual accounts, joint accounts, accounts for corporations, and retirement accounts each count separately. SIPC covers $500,000 in securities, including a $250,000 limit on cash per account with separate capacity. So if you have an individual brokerage account, a Roth IRA, and a traditional IRA, all at Schwab, each of those gets its own $500,000 protection. That's $1.5 million in coverage before you even touch the excess SIPC policies. A Roth IRA and a traditional IRA at the same institution are treated as separately insured accounts, providing a total of up to $1 million in protection, $500,000 on the Roth and $500,000 for the regular IRA. But now you might think, okay, what does that protection actually do in practice? Let's look at what happened the last time a major brokerage firm actually went under. Bear Stearns. March 2008. Bear Stearns had survived the Great Depression, the stock market crash of 1987, and the September 11 attacks, growing from 3 employees to more than 15,000 by 2007, with trading desks around the globe. By March 11, 2008, when Moody's downgraded Bear Stearns mortgage-backed securities, panicked hedge fund customers sparked a bank run, withdrawing their investments en masse and depleting Bear Stearns' liquidity from $18 billion on March 10th to just $2 billion on March 13th. On March 16th, 2008, Bear Stearns, the 85-year-old investment bank, narrowly avoided bankruptcy by its sale to JP Morgan Chase at the shockingly low price of $2 per share. The stock had been worth over $80 just 12 months earlier. Here is what happened to the retail clients who had brokerage accounts at Bear Stearns. Almost nothing bad. Their accounts were transferred to JP Morgan. The assets, the stocks, the bonds, the mutual funds were theirs. The storage facility had a new owner. The furniture never moved. That is the system working as designed. If your brokerage shuts down or becomes insolvent, other layers of protection shield you from loss before SIPC even needs to step in. As FINRA points out, in virtually all cases, customer assets are safe and typically are transferred in an orderly fashion to another registered brokerage firm. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. Now, MF Global. This is where the story gets genuinely frightening, and it's also where you have to pay very close attention to one very specific word. On October 31st, 2011 Halloween Day MF Global, a large brokerage firm registered with both the SEC and the CFTC as a futures commission merchant, filed for bankruptcy, marking the 8th largest bankruptcy in US history. MF Global's failure resulted in a $1.6 billion shortfall in customer funds. Hear that number? $1.6 billion gone. Improper commingling, mixing of company and client funds took place for days before the illicit transfer and loans, and perhaps for many other days earlier in the year. According to the New York Times, MF Global dipped again and again into customer funds to meet the demands, perhaps beginning as early as August 2011. So what happened? The storage facility broke the only rule it had. It sold your couch to pay its own debts. Approximately $3.9 billion from accounts frozen when MF Global entered bankruptcy was returned. For customers in the US, that translated to a recovery of about 72 cents for every dollar they had invested. Initially, eventually, customers were made whole. In January 2013, a judge approved a settlement that would return 93% of customers' investments, with the prospect of additional payouts from the company's general estate. Customers have since received distributions, making them whole. But those customers waited years. Their money was frozen. And the reason MF Global was able to do what it did, the reason it could raid customer accounts, comes down to a single word: futures. MF Global was primarily a futures and commodities broker. MF Global was a brokerage firm that specialized in futures and derivatives, and its clients consisted mainly of farmers, grain operators, and hedge funds who turned to the firm to trade in commodities like wheat and corn. Futures accounts at the time were regulated by the CFTC under different rules than standard securities brokerage accounts regulated by the SEC. Cash held in connection with a commodities trade is not protected by SIPC. This is the reversal I want you to understand. You think the MF Global collapse is an example of what can happen at your Schwab account. It's not. It's an example of what happened to a fundamentally different type of brokerage, operating under fundamentally different regulatory rules, with fundamentally different customer protections. If you hold stocks, ETFs, mutual funds, and bonds at Schwab, Fidelity, or Vanguard, your accounts are governed by the Securities Exchange Act and SIPC, not the CFTC rules that allowed MF Global's nightmare to happen. A New York federal court eventually imposed a $5 million civil penalty on John Corzine, MF Global's CEO, for his role in the unlawful appropriation of customer money. Additionally, he received a permanent ban from registering with the CFTC or working with any futures commission merchant. The $5 million fine represented less than 0.5% of the $1.6 billion in customer funds that went missing. Make of that what you will. Amused disappointment is the correct response. Here is the even more important point. The reason MF Global matters for this conversation is not because it's a blueprint for Schwab's collapse. It's because it shows you the exact mechanism that actually creates real risk, the commingling of client assets with firm assets. And that is precisely what the SEC's customer protection rule is designed to prevent for standard broker-dealers. Under FINRA rules governing brokers and dealers, investors and brokerage firms' assets must be segregated. They may not be commingled. It could be a civil or criminal violation if an investor's assets were inappropriately commingled. The risk is real. The mechanism that would create it is also specifically illegal. That is the double layer. Now, there's something about Schwab's insurance numbers you need to hear. And when I tell you this, I want you to do the math yourself and let it land. Schwab has 38.3 million active brokerage accounts and $11.83 trillion in client assets as of November 30, 2025. Schwab's combined SIPC coverage and excess SIPC coverage through Lloyd's of London provides protection up to an aggregate of $600 million, limited to a combined return of $150 million per customer. $600 million against $11.83 trillion. That is roughly $1 of aggregate excess insurance for every $19,700 in client assets. Or put differently, if Schwab collapsed and every dollar of client assets somehow went missing, which, to be clear, is essentially impossible given segregation rules, Schwab's excess insurance pool would cover about 0.005% of client losses. The insurance is not the safety net. The segregation is. The insurance is the last resort, last-ditch backstop for fraud scenarios, not for the firm's general failure. But Tom, Fidelity has more coverage. Fair. Total aggregate excess SIPC coverage available through Fidelity's excess SIPC policy is $1 billion. Within Fidelity's coverage, there is no per customer dollar limit on coverage of securities, but there is a per customer limit of $1.9 million on coverage of cash awaiting investment. Fidelity is the fourth largest brokerage in the United States, with $6.4 trillion in assets under management. $1 billion against $6.4 trillion. Same ratio problem. I want to be crystal clear. This is not a reason to panic. This is a reason to understand how the system actually works. The insurance is not designed to cover the entire asset base because the entire asset base never goes missing. The assets are yours. They are legally separated. In virtually every real-world brokerage failure, the assets are transferred to a new firm intact. The insurance covers the gap in the rare scenario where some assets go missing due to fraud. The magnitude of what SIPC covers is small because the magnitude of what actually goes wrong is small. Here's what this means in practice. If you have $500,000 in stocks and ETFs in a single brokerage account and your broker collapses, SIPC covers that account fully. If you have $2.5 million in a single individual brokerage account, you have $500,000 in SIPC coverage and up to $150 million in Schwab's excess coverage. But if total losses at Schwab somehow exceeded $600 million aggregate across all clients, that excess pool gets divided up. Your actual first line of defense is segregation, which is rock solid. Your second line is SIPC. Your third line is the excess policy. Each layer exists because the one before it is designed to hold. This is where it gets Really interesting. Because there is a fourth scenario that has nothing to do with any of these three layers. And it's the one most people walk right into without knowing it. Let me tell you about your cash. Every time you sell an investment or deposit money into your brokerage account that you haven't yet invested, that uninvested cash goes somewhere. By default, at most major brokerages, it goes into what's called a cash sweep program. Schwab automatically sweeps your idle cash into something called the bank sweep feature, which means that money gets transferred to a linked bank where it earns FDIC-insured deposit interest. Another option offered by some brokerage firms is a bank sweep program. In a bank sweep program, your brokerage firm automatically transfers unused cash from your brokerage account into a bank account. There, the cash is protected under banking laws and may be insured within FDIC limits. Since cash in a bank sweep program is held outside of the brokerage firm, SIPC would not protect these funds if your brokerage firm fails. Read that last sentence again. If your uninvested cash has been swept to Schwab Bank, it's now at the bank, not at the brokerage. If the brokerage fails, SIPC does not cover that cash. The FDIC does. Up to $250,000 per depositor per bank, and only if the bank is FDIC insured. This is where the subplot of the cash sweep gets genuinely uncomfortable. Between June and September 2024, 8 class action lawsuits were filed against Schwab, Morgan Stanley, Wells Fargo, and others. The claim: they breached their fiduciary duty by paying customers rock-bottom rates while keeping the bulk of the interest for themselves. Dr. Karen Petru of Federal Financial Analytics called cash sweep programs a $15 billion annual hidden fee stream in testimony before Congress in September 2024. But the rate problem is the visible part. The protection gap is the invisible part. Here is the scenario that keeps me mildly annoyed at how this is structured. You have $300,000 in uninvested cash sitting in your Schwab account. By default, Schwab sweeps that to Schwab Bank. Charles Schwab & Co. Inc. is not an FDIC-insured bank deposit. Insurance covers the failure of an insured bank. Charles Schwab & Co. Inc. is a brokerage firm and a member of SIPC, which provides protection for brokerage account assets. The brokerage and the bank are separate entities. Your cash has left the brokerage, it's sitting at the bank. If the brokerage collapses tomorrow, SIPC does not cover that money. The FDIC does up to $250,000. You have $300,000 there. $50,000 is in a gap, not insured by SIPC, not fully insured by FDIC. That's the scenario that doesn't show up in the marketing brochure. The fix is surprisingly simple, and I'll give it to you in the practical section at the end. But hold that thought. Here's the part that never makes it into a standard retirement conversation. Knowing the risks inside your brokerage account and actually building a system to account for them are completely different things. I've spent 10 plus years running my own business, surrounded by accountants and fiscal lawyers, and I can tell you the gap between knowing and structuring for is where most of the financial damage actually happens. I built a digital book called The Exit Code, 8 chapters of pure retirement research, no filler, no fluff, built entirely on 50 years of actual retirement data. And one of the mechanisms it covers in detail is what I call the 4% trap, the popular withdrawal strategy that sounds safe on paper but fails in specific market sequences. There's also a mechanism I track called the 58% rule, the share of Americans who exit the workforce before they plan to, usually due to health or layoffs, and the buffer strategy that protects them. If you're building wealth through passive investing and planning to eventually live off it, these aren't abstract concerns. The math framework in the exit code turns maybe someday into a specific date with a specific number. It costs less than a dinner out through the link in the description. Now, back to the part where Vanguard is genuinely different from everyone else. Vanguard has one of the most unusual corporate structures in the history of American finance. Unlike other brokerages, Vanguard is owned by its funds, which are owned by investors like you. This mutual ownership structure means no outside shareholders demanding profits. Vanguard operates at cost for investors. This structure significantly reduces the risk of bankruptcy compared to traditional for-profit brokerages. Here's what that means structurally. Since Vanguard Group Inc. is actually owned and funded by the various mutual funds, for all practical purposes, it won't go bankrupt unless all of the various mutual funds that support it went bankrupt. The only way that could happen would be for the value of all of the stocks and bonds held by each and every individual Vanguard mutual fund to go to zero. So forget about Vanguard going bankrupt. It just isn't going to happen. That's not cheerleading. That's a description of the structural incentives. If Vanguard's corporate entity somehow collapsed, the funds themselves, which are the thing that actually holds your money, are separate legal entities. Vanguard is a distinct and separate legal entity from the funds in which you are invested. It is the service company that provides transfer agency services and administrative services. Because the funds in Vanguard are separate legal entities, if Vanguard were to enter bankruptcy, Vanguard's creditors could not claim the fund's assets to pay Vanguard's obligations. Each fund's assets would remain in the protective custody of the fund's custodian bank. And what is that custodian bank? By law, Vanguard and every other US regulated mutual fund company must hold their assets with a third party. Many of the funds managed by Vanguard hold their assets with JPMorgan Chase. JPMorgan is audited by PricewaterhouseCoopers, which provides additional independent verification that Vanguard's funds hold what they're supposed to. Think about that for a moment. Vanguard doesn't even hold its own fund assets. JPMorgan Chase holds them separately, under independent audit. The fund manager decides what to buy and sell. The custodian actually takes delivery and holds the securities. Even if Vanguard were to somehow go broke, Vanguard has no recourse to the assets of the funds. Rather, each fund's custodian holds those assets. Even the fund managers do not have custody of their fund's holdings. They simply decide which stocks and bonds to sell, and the custodian actually delivers or takes delivery of the actual asset. This is completely different from what Lehman Brothers was doing with money. Lehman was an investment bank leveraging its own balance sheet. Vanguard is a service company managing funds that are legally insulated from Vanguard's own financial condition. Different species entirely. But hold on. Let me introduce a parable here, because this distinction about mutual fund custodians applies to Fidelity and Schwab funds as well, and it's one of the least understood protections in personal finance. There's a man, let's call him David, who retires in the summer of 2008 with $800,000 in 3 Fidelity mutual funds held at a Fidelity brokerage account. September comes. Lehman Brothers files the largest bankruptcy in US history. The S&P 500 loses 57% peak to trough. David loses real money, not to fraud, not to a brokerage failure, but to the market doing exactly what markets do. SIPC is not involved. SIPC cannot help him. His funds went down in value because the underlying companies went down in value. The storage facility was fine. The couch lost value because the couch market crashed. It is important to recognize that SIPC protection is not the same as protection for your cash at an FDIC-insured institution, because SIPC does not protect the value of any security. Investments in the stock market are subject to fluctuations in market value. SIPC was not created to protect these risks. That is why SIPC does not bail out investors when the value of their stocks, bonds, and other investments falls for any reason. The market going down is not a brokerage failure. This seems obvious when you say it out loud, but I'm telling you, the number of people who confuse my portfolio is down 40% with my brokerage is failing is not small, especially in a real crisis. Your brain is not well calibrated for distinguishing those two things when both feel equally terrifying. The brokerage equivalent of someone saying, but Lehman went bankrupt and people lost money? Yes, Lehman went bankrupt. Lehman shareholders lost everything. But Lehman's brokerage customers, their accounts were transferred to Barclays. The furniture moved to a different storage unit. Here is a comedic representation of how this conversation typically goes at Thanksgiving. I heard Schwab is in trouble. Where did you hear that? Reddit. And your evidence? It said a lot of people are worried. That's the couch. Actually, here's a more accurate version. Your neighbor finds out Bear Stearns collapsed in 2008. He calls his financial advisor in a panic. The advisor says his brokerage accounts are fully protected and the money will transfer to JP Morgan. The neighbor doesn't hear any of that. He hears Bear Stearns. He liquidates everything into cash, puts it in a savings account, earning 0.3%, misses the entire recovery from March 2009, and is still somehow convinced he made the right call. Now here is the part where I give you the numbered framework that actually matters, because we've covered the theory and the history, and I want you to walk away with something concrete. There are 3 levels of risk in your brokerage account, and they each need a different response. Level 1 is the investment risk. Your market value can drop. No insurance covers this. SIPC, FDIC, excess SIPC, none of it. The asset itself declined. This is the risk you take by investing. The only tools against it are diversification, time horizon, and not panicking. This is not what this video is about, but I want to name it explicitly so your brain doesn't lump it in with the other 2. Level 2 is the custody risk. Your brokerage firm fails, and during the process, some of your assets go missing or temporarily inaccessible. This is what SIPC covers. For most investors with under $500,000 in a single account type, you are fully protected. For investors with multiple account types, individual Roth IRA, traditional IRA, joint, you can get up to $1.5 or $2 million in SIPC coverage with some basic account structuring. If your brokerage firm goes out of business, there's a good chance it will be acquired by another company, and your assets and securities will be transferred to the new custodian through a relatively seamless process. SIPC is the backup to that backup. Level 3 is the cash exposure risk. This one is specific, narrow, and actionable right now. If you have large amounts of uninvested cash sitting in your brokerage account that has been swept to a bank program, you need to know exactly how much is there, which bank it went to, and whether it exceeds the FDIC limit at that institution. Cash in a bank sweep program is held outside the brokerage firm. SIPC would not protect these funds if your brokerage firm fails. If you're holding more than $250,000 in sweep cash at a single bank, you have an exposure. The fix is to put that excess cash into a money market fund instead, which SIPC treats as a security, not as cash. Money market mutual funds, often thought of as cash, are protected as securities by SIPC. Let me give you a realistic scenario with numbers. Mark is 47 years old. He has $900,000 at Schwab, $350,000 in a Roth IRA invested in Schwab's S&P 500 index fund, $350,000 in a traditional IRA in a total market ETF, and $200,000 in an individual brokerage account, of which $150,000 is in stocks and $50,000 is sitting in uninvested cash that has been swept to Schwab Bank. Here's Mark's actual exposure breakdown. His Roth IRA is covered by SIPC up to $500,000, fully covered. His traditional IRA is covered by a separate SIPC capacity, up to $500,000, fully covered. His individual account has $150,000 in stocks fully covered by SIPC. His $50,000 in sweep cash is at Schwab Bank, covered by FDIC, not SIPC. He is 95% fine with 0 action required. The only thing Mark should consider is whether to keep that $50,000 in a money market fund rather than the bank sweep if he wants the full SIPC coverage umbrella instead of the FDIC one. That's it. That's the entire risk management exercise for a $900,000 account. The answer to the title question of this video is, for the vast majority of investors, almost nothing bad happens to your investments in a brokerage collapse. They transfer. You wait a few weeks. You get access again. The system is not perfect. MF Global proved that futures customers in a specific regulatory context can get caught in a real liquidity freeze. But for standard equity and bond investors at the 3 largest brokerages in America, the legal infrastructure around custody is genuinely robust. Now, to close the loop on the cash sweep subplot, here's the most underreported part of that story. Charles Schwab was paying 0.01% APY on its bank sweep program. That's a 424 times difference compared to some competitors. On $50,000, that's $2,125 versus $5 a $2,120 gap in just 1 year. You are not just potentially underprotected on excess sweep cash. You are also getting paid nothing to hold it there. 2 problems, 1 source. SIPC's coverage limit of $500,000 was set in 1980 and is no doubt inadequate today. On average, investors between the ages of 55 and 74 have more than $500,000 in retirement account holdings, according to Federal Reserve data. That means the average investor in this channel's primary demographic has more than the standard SIPC limit. The good news is that account type diversification solves most of that, but you have to know to do it. The 3 practical takeaways from this video. First, check your account types. An individual brokerage account, a Roth IRA, and a traditional IRA at the same firm each get their own $500,000 SIPC coverage envelope. If you have a spouse, a joint account adds another. Structuring this correctly is free and takes 10 minutes. Second, check where your uninvested cash lives. Log into your brokerage account right now and find the cash sweep setting. If it's in a bank sweep program, check the bank and the balance. If it's over $250,000, you have an FDIC gap. Switching to a money market fund moves that coverage to SIPC, which is structured differently but covers the full $500,000 combined with your other securities. Third, understand what you actually own. If your holdings are stocks, ETFs, and mutual funds in regulated accounts at Schwab, Fidelity, or Vanguard, the segregation rules mean those assets are yours, not the brokerage's. The brokerage can fail, the assets survive. The real risk isn't Schwab going bankrupt. Schwab has over 38 million active brokerage accounts and $11.83 trillion in client assets. The incentive structure, the regulatory oversight, and the ownership model all create massive barriers to the kind of failure that would actually threaten client assets. The real risk is the investor who confuses market volatility with institutional failure, liquidates everything into a sweep account at the bottom of a crisis, earns nothing while waiting, and calls it being careful. Lazy investing built more fortune than crypto memes. And the people who understand how their accounts are actually protected, actually read the boring documents, are the ones who don't sell at the bottom because they misunderstood what was happening.